Market volatility remains high, very high, as markets swing with every headline from the Middle East. The reality is that investors still know very, very little about how this conflict will evolve, and that uncertainty is driving sharp moves across asset classes across the world, both up and down. But what is clear is that oil prices remain the key transmission channel to global financial markets, and they will be the ones that will determine how widespread the implications of this Middle East war will be for global economies and central banks. So welcome to Swissquote's Daily Market Talk. It's 10th of March. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
Really, rare are days in the markets where you have this much volatility. Asian indices were deeply sold yesterday when I came to my desk, while US and European futures were down by around 2 to 3%, as US crude prices had spiked up to $120 per barrel level at the open on escalating conflict in the Middle East. But then crude spent the day retracing these gains and ended Monday's session with more than 7% move downwards, near $85 per barrel level. The catalyst was the announcement that the G7 countries would release their strategic reserves. Ooh, the latter really helped pour cold water on the crude rally. European indices recovered early losses, and US indices ended the day in the positive on mounting speculation that the Iran war would end soon too. How soon? Well, no one really knows. Why would it end? That too, no one really knows, but Trump said that it would end soon. Not this week, but soon, so we wait. Nasdaq gained up to 1.38% yesterday on these words, showing that bulls are impatient to trigger a fresh rally without a dip, probably. Why to bother wait for a dip? The problem is the strategic reserves that the G7 countries are talking about is around 300 to 400 million barrels reportedly. The global oil demand, on the other hand, is about 100 million barrels per day. So we are talking about 3 to 4 days of meeting the global oil demand here. That's not much, really. Plus, Middle East producers are now cutting their oil production as the reserves are getting full. Saudi Arabia, for example, is also selling its oil for immediate delivery, whereas they prefer long-term contracts normally. They are clearly trying to feed the market as fast as they can right now. Other and more noteworthy news is that Saudi Arabia is now rerouting its crude toward Yanbu in the Red Sea, where it could export up to 5 million barrels per day of oil. In comparison, Saudi pumps around 10 million barrels per day, and they export around 7 million barrels per day of it. So rerouting production wouldn't be a perfect solution, but could help obviously. And if things go really, really bad, the Russian oil could also re-enter the circuit. But all of these solutions may not pull oil prices to pre-war levels. US crude was trading below the $68 per barrel level before the Iran conflict started. It could stay above the $80 per barrel level until we see a clear resolution. Now, of course, the market pricing changes by the minute and nothing is sure, but yesterday's spike in oil prices shook the European Central Bank and Bank of England expectations quite dramatically, as the rising oil prices combined with strong US dollar will have an immediate effect of rising inflation in Europe. As simple as that. As such, swaps were pointing at 2 full 25 basis point rate hike from the European Central Bank this year, compared to just one rate hike last Friday. While the Bank of England expectations went from rate cuts to a rate hike, as inflation in the United Kingdom, which is very, very sensitive to energy prices, could be more than the double of the Bank of England's expectations pre-war, according to the ING forecast. They actually see inflation in the UK near 5% level into the third quarter of this year versus the expectation that inflation would ease to the Bank of England's 2% target by the same time this year, but that was before the war. Now, the funny thing is that the Bank of England hike expectations were valid a good part of the day, but by the time yesterday's session ended, the BOE rate hike chances vanished to almost nil, leaving behind a very crazy volatility and very high uncertainty about what's to come. Pricing in the FX reflect the volatile expectations, of course. The euro dollar tested and rebounded from the 115 mark yesterday, but obviously the move was mostly on the back of the US dollar gaining, then giving back its gains as the session went from fear to greed around Iran and the Middle East conflict. Same with cable, the pair dipped below the 133 level at the open and ended the session above 134. The dollar yen, on the other hand, approached the 159 level yesterday. Here we are very close to levels around 160 that spook officials in Japan and could trigger at least a verbal intervention to stop the yen's depreciation. But at the end of the day, it all comes down to the US dollar and to the war headlines and to energy prices, really. So I'm afraid this uncertainty will continue a few more days and weeks. The fact that investors overreact to every piece of news out there without questioning the feasibility is adding another layer of challenge to navigate the financial markets today. Because look, a part of yesterday's optimism was because Donald Trump said that the war in Iran would end soon and that the US was ahead of schedule. But when asked how soon, he said, well, not this week. So how soon? I mean, it's not really soon then. Meanwhile, concretely what's happening on the field is that the conflict and the Middle East continues at full speed, with political news not pointing at a new term resolution at all, and there is little information out there about the US plans in this war. Even the US official statements, their official statements contradict each other. As a result, crude oil rebounds again this morning in Asia. It was up by around 5% when I first looked at my chart this morning, and now it is up by less than, well, around 4%. It's really moving very, very quickly. The price action will depend obviously on geopolitical developments and the news, and the best thing to do right now for investors is to hold on and not to overreact, not to react in panic if they have the possibility to do so. Now, speaking of inflation, the world is facing inflation led by energy prices. The fertilizer prices are up as well, as we discussed that in detail in yesterday's market talk, threatening to push global food inflation higher as well. Then there is the memory chip inflation that's also going on right now that will push the prices of PCs, cars, and gaming consoles higher. How high? Well, it will all depend on the company's ability to pass these costs on to their clients. But Bloomberg reports that in some cases, the DRAM prices, so the price of most common working memory in computers, soared around 700% over the past few months. So we will see the impact on global inflation as well. Now, in a very good news in yesterday's session, HPE gave a better than expected revenue outlook when it releases earnings yesterday, and its price jumped more than 3% in yesterday's trading session, while Oracle, which is the barometer of AI debt risk right now, is due to announce its own earnings today after the closing bell in the US. Investors here will focus less on the headline numbers and more on whether Oracle can confirm that AI-driven cloud demand remains as strong as markets believe, and whether the company could meet its obligations. The key metrics will be growth in Oracle's cloud infrastructure, OCI, the size of its AI-related backlog, and also the CapEx guidance for new data centers. Strong OCI growth and rising backlog would signal that companies are still aggressively spending on AI computing power, which could help reinforce demand for chips from players like Nvidia, for example, and support the broader AI infrastructure trade. But if cloud growth slows or CapEx rises without clear demand visibility, then investors will continue to question whether the AI investment boom of today is running ahead of real revenue, and the latter would revive the worries that the industry is taking just on too much leverage, and that's not necessarily good for the AI trade. So let's see what Oracle will say, and let's see what happens in the Middle East. But this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.